Okay, welcome back to Rockstock Channel. It is Wednesday, December 6th, 6 o'clock in the morning, my time. We are very privileged to have, I think for the fourth time, Ken Brinsden, who's the chairman of Patriot Battery Metals, but used to be the CEO of Pilbara Minerals. And we have a lot to talk about. There's been a lot of activity in M&A in Western Australia in lithium, but Ken used to run Atlas Iron and is very experienced in the iron ore space as well, and has some experience with Chris Ellison and Gina Reinhardt and the like. Before I start, I have a bunch of props. I'm wearing a Rolling Stonks t-shirt from the No Filter Tour in 2019. So this is going to be a no filter conversation. I don't know if you can see it, but I have a lava lamp over there, and I'm about to burn some incense, with my Rolling Stones incense holder. A bit of a kumbaya moment here. I also have this prop. This is from the Beijing Olympics in 2008 when I was very involved in iron ore. I didn't actually go to the Olympics, but a client of mine gave me this plushy toy that was popular there. And also in Bull's Lair is this book on the Pilbara. So we've had a lot of experience, Rodney and me and you, Ken, with cycles in iron ore and lithium. We've called it LIFE, the good life, the wonderful life, life in the fast lane, Gina and Chris Ellison. Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. Let's just kind of talk about that. There's like a dichotomy of strategics making bids primarily for Western Australian spodumene assets, although we saw the Chinese kind of coming into Brazil yesterday in Atlas Lithium. So there's an element of, in the iron ore space, you have Vale in Brazil and, the big three in Western Australia, Rio Tinto, BHP, and Fortescue. Going back to the four times we've had you on, the first was in 2019, where we were using Men at Work, who can it be now? Because you had an auction underway at the time following MinRes's auction for Wodgina, where Albemarle came in. That auction didn't finish with a positive outcome because the market, was going down from 2018 and you were in 2019. So they were a bit ahead of you, and the market just wasn't there. We then had you on in September 2021, and the market had started to tick up, or had more than started to tick up. You had your BMX auction, and we entitled that Spodumene Speculation. We've since had Dale Henderson on and have called this kind of spodumene software. And then last time we had you on was March of this year, as part of our Canada Rocks conference, which was exclusively focused on Canada spodumene. And you are now the chairman, as I said, I think, of Patriot, talking about, the market there. I listened to that interview this morning, and I reminded myself that the BMX auctions that Pilbara had pioneered, had just stopped, around, prior to March. So in hindsight, that was like a signal, that we should have been, maybe leaving the market for a period of time. Pilbara is the most shorted stock, I think, on the ASX. I think 20% short, despite having a pristine balance sheet. Guangzhou futures, which just started in July in China, is at record lows. It's done nothing but go down. The Wuxi futures, the things that, like, these are things that people are watching every day in the way that they were watching those, kind of BMX auctions. So you had spoken about that during COVID, China just didn't stop building conversion, and that the demand for hard rock was just, insatiable. Demand numbers, EV, ESS, Rodney keeps saying, are strong. They're out of China. So what's happened this year? We had a fall through March, April. We called a bottom. We spiked back, 70% up, I think, by June, July. And then, we've since just gone, nothing but down. We thought this was restocking. Is it a demand problem or is it a supply problem? Because, lithium's very abundant. There's lepidolite in Australia. I'm sorry, lepidolite in China, African. Like, what's your assessment of like where have we got this wrong? Like structural deficit we've all been talking about. And on the other hand, Goldman Sachs, we all made fun of Goldman Sachs saying, price is not going to go down to 11,000 in 2024. But the reality is that they undershot their forecast in 2023. It's actually a lot lower than they had forecast when they first made that call. So with all of that as a backdrop, give us some initial thoughts, and we could dig deeper into a lot of the questions that are embedded in this lead-in.
Well, Howard, Rodney, really nice to be with you. Thanks for the chance to participate again, guys. I really appreciate it. And Howard, you've got me doing a whole heap of reminiscing there, I think. Combination of highs and lows in the iron ore industry and of course now lithium. So where to start? I think it's safe to say that China is both still the world's most important lithium raw material market, but it's also a complicating factor because there are many things that are unique about the China market and doing business with China. One thing that I've come to accept over time is that when you're doing business with China, you're going to have to expect volatility. And it's principally motivated by, I think, a couple of things. Firstly, when everybody thinks about business in China, they want to give them credit for being long-term thinkers. But I've come to the conclusion over the decades that might be giving credit not completely where it's due, because that argument might be true when you're dealing with government interests, but actually in business, they don't really think particularly long-term. In fact, their behavior in markets is actually really short-term thinking, and that's why you'd get these extremes in pricing outcomes. And honestly, I've seen it. I don't want to draw too many parallels to iron ore markets. Save to say, historically, there's been huge volatility in iron ore pricing going into China, and especially with the emergence of spot markets in China. And now I think something similar in respect of lithium. The tension in Chinese markets is motivated by everyone wanting to buy on the same day, but equally wanting to sell on the same day when the market's going the other way. So the first thing I would say is when dealing with China, that volatility is to be expected. Now, the other key determining factor here is also where China goes when they're looking to solve a problem. And honestly, I feel like the current environment can at least in part be explained by sourcing lithium from novel jurisdictions, but equally novel products. And the rise of the and pedalites and even some of the direct shipping ores are all part of a classic kind of China response to facilitate more supply. If that was all it was, I would probably stop there. But I also have a view that China's inclined to subsidise that sort of novel supply with a view to solving a bigger problem. They don't want lithium raw materials at $60,000 or $70,000 a tonne. They want it, whatever the number is. Let's say it's sub $30,000 or sub $25,000 a tonne, and as a result, they're prepared to back in novel sources of supply that solve for probably a shorter term supply solution. Now, I say all that, but I don't want to sound like a conspiracy theorist. To me, in many respects, that's actually a natural thing for China to do, and they have a track record of doing it. I think something similar happened in the iron ore industry, drawing a parallel to domestic magnetite supply. And it's one of the reasons why iron ore now struggles to get below, $100 a tonne, because the market's been underwritten by projects that really, if you were genuinely competing for capital, shouldn't have been developed. So in my sort of humble view, what's really happening here is that we're sowing the seeds for, the next run up in pricing that probably, surprises us all again. But perhaps more important than that, underwrites a stronger for longer, long run price in lithium raw materials. And that's because the allocation of capital gets grossly upset by interference, in the market. So it's a long-winded way of saying China, both a very important market, but equally a complicating factor. What else do you draw from the current experience? You'd simply say you hope over time the right projects attract capital. And I've also got to say there'll be some disassociation, and in particular in the next 5 to 7 years, with a view to developing new supply chains that afford an opportunity to bypass China. And the seeds of that are already starting to happen. The plants being developed here in Western Australia, Wesfarmers, Albemarle at Kemerton, and Tianqi IGO at Kwinana. I would argue with more to come. I have a particular interest in the North American and European markets as a function of my involvement at Patriot. It seems to me that there'll be a more concerted effort in the coming 5 years to build out these alternate supply chains so that you're not completely reliant on the China supply solution or value-added chemical solution. I shouldn't forget the work that POSCO and Pilbara are doing in Korea to further diversify supply chains as well. They're all really important initiatives, but it's just the beginning. There's a lot more of that to come. You'd like to think that the effect of all that will actually be to smooth the market. It's interesting to me that in Japan and Korea, lithium raw materials or value-added chemicals still $35 a kilo, perhaps more. I think that tells you something. The volatility in China is a bit of a unique beast. In the longer run markets, something that looks a little bit more, relatively speaking, stable pricing. Didn't hit the highs that it hit in China, but probably equally won't hit the lows that were hit in China either. So yeah, agree, Howard. It's a vexing time, and I appreciate that investors must struggle with this volatility. We, as in lithium raw materials, are 10 years ago a boutique industry. Of course, quite a bit of growth going on in the subsequent decade, but relatively speaking, still a smaller market growing, and you're going to from time to time get these disconnects emerging, and to a certain extent we've got to kind of suffer through it to get to the other side, but inevitably you do.
It's a great explanation, Ken. Just you touched on something, and I guess I'll switch around the question slightly, because as much as we want to see an ex-China supply chain, how realistic do you think it is to expect that we'll have a reasonably sized ex-China supply chain before 2030?
Yeah, I'm optimistic, Rodney. I think it's a huge issue for Western markets, the extent to which the industry as a whole is reliant on China, and it is going to force some really serious investment in these alternate supply chains. And in fact, the IRA, I guess, has started that process. There's already significant developments going on downstream in cell making capacity, cathode plants, and a little bit as it relates to value-added chemicals. But I would argue there is going to be a lot more. And what it comes down to is the dire straits that I think Western car makers are in, driven by the competition that's emerging from China. So what Western car makers are faced with is not only having to rearrange their supply chains to support growth in EV sales. I believe customers are ready for it. That's basically what's happening. As long as you've got a product that's cost competitive, I think they're selling well. Maybe the US is the one exception, but if you look in Europe and even here in Australia on the roads, there is plenty of EVs emerging, and actually a lot of Chinese EVs. BYD's been a massive seller here. So what do you do if you're a Western car maker? You've got to reshape your supply chain to support future EV production. But worse than that, you've got the Chinese product in your market today dominating, basically. And it's because it's competitively priced, and I think you could rightly argue it's a quality product. So a consumer is buying the EV. They're just not buying the VW, the BMW, the Merc, the GM, because they're not competitively priced. China's already got there because they were investing 10 years ago. The Western OEMs have 10 years worth of catch up to do. So the reason for dwelling on that subject matter is to say, how does a Western car maker survive in the face of that competition? My take is that they'll be supported by governments who are otherwise going to see their industry decimated. Western car makers are not going to survive against that competition because they're 10 years behind. So you will see an IRA style response to force the issue to basically get these supply chains in place so that their car industries can literally survive. Otherwise, they'll be dead. They won't exist.
Ken, I want to pick up on that point, but also a number of the other ones that you were talking about before. Andrew Ross Sorkin, in his recent DealBook interview with Elon Musk, his berating of the media advertisers got all the press, but there was a question there that we'll insert into this video.
Refutation of that is that the Tesla Model Y will be the best-selling car of any kind on Earth this year. Of any kind, gasoline or otherwise.
Is there another car company that you think is doing a good job with EVs?
I mean, I think the Chinese car companies are extremely competitive. By far, our toughest competition is in China. So, I mean, there's a lot of people who out there who think like the top 10 car companies is going to be Tesla, followed by 9 Chinese car companies. I think they might not be wrong. So, China is super good at manufacturing, and the work ethic is incredible.
And Elon Musk responded in the same way that you responded, is that his biggest competition is from China. So there's Tesla at the top, and then the next 9 are Chinese, as he thinks about competitors. And the Chinese market's very competitive, and Tesla does very well in there, but that goes straight to the point that you're making. But I also worry, we have an election coming up, and there, EVs is a red state, blue state kind of thing, Democrat, Republican thing. There are some people here in America who say that EVs are a solution without a problem, right? ICE cars are relatively cheap. But on the other hand, a lot of the IRA benefits are in red states, and you do have a lot of battery factories being developed there. On the other hand, GM just gave $10 billion back in share buybacks, because they're making money from, big trucks, and they also increased their dividend. So why are they not investing in EVs? Like, it's going to look really bad politically in a couple of years if all of a sudden GM is being bailed out because their EV strategy didn't pan out, and they had just kind of like done these buybacks. So I don't know. This is going to play out next year in U.S. politics. The investments and the rules, the guidance is out now on what is a foreign entity of concern, from a minerals point of view and a battery point of view. But I as an American, I hope and don't think. I just don't think that they're going to allow the Chinese automakers to come to America in the way that the Koreans have, in the way that the Japanese have over the last kind of a couple of decades. but it's a complex issue because we're so intertwined with China otherwise. So to be seen, on that, it is a bit of a demand, consideration. Going back to this, I do want to make this comparison to iron ore and lithium, and I know it's not the same, but spodumene is relatively close. We're talking about spodumene software, stronger for longer. Iron ore price has been higher for longer. Someone joked about it's no longer spodumene software. It could be like, hard rock hardware, right? From a margin perspective. And actually it could go down to spodumene supermarkets. Like it could be, very thin margins. But you had argued, you made a comment about the magnetite in iron ore. Someone I spoke to, I've been having lots and lots and lots of conversations over the last kind of few weeks, just a little bit paranoid. Can lithium become like uranium and uninteresting for kind of like 10 years? Or is this just like a cyclical downturn as part of a continued structural, deficit, and secular, upturn? But someone told me that a number of years ago in the iron ore market, China made this big announcement about some big project in China, that kind of spooked the price of iron ore. I don't remember exactly what he was referring to. Maybe you'll remember that, but he was comparing that to, the CATL, sodium ion scare, earlier this year, just like big China puts out like a big worry that something could be displaced in order to talk down the price. What were you referring to when you mentioned the magnetite story that worked away from China, and resulted in this very persistent, stronger for longer software margins in the iron ore space?
Yeah, I think it's reasonably simple. The concept that there is only, so if you want to draw the parallel to iron ore, there's very few Yandi mines, mining area Cs, Brazil's S13 or whatever it's called. The concept that you have ultra high grade, conveniently located to logistics ports that facilitates a very, very low cost. Those projects are relatively rare. They're relatively rare in iron ore. They're relatively rare in gold. They're relatively rare in copper. And then you have a whole heap of projects that otherwise build out the right-hand side of the cost curve. So the link to that I'm referring to that relates to this concept of iron ore pricing is that China got very aggressive as iron ore pricing ran up in the period post the GFC. So now I'm referring to, let's say, 2009, 10, 11, and 12. And a lot of new production made it to market that was domestically in China that was underwritten by low-grade magnetite production to access iron ore. And I think the rhetoric at the time was, it's a game changer because it's so low cost, and we can underwrite our supply domestically and lessen our reliance on Pilbara and Brazilian iron ore. But the truth is, it's not low cost, and it was never going to be, because it's very low grade. It's not necessarily conveniently located, and it requires a lot more processing than your standard sort of direct shipping ore that you might otherwise get in the Pilbara or very high grade product from Brazil, for example. So it feels like a similar thesis is emerging now as China looks for novel supply responses, and actually even matching it with a bit of jawboning around what's really happening there. Is it really low cost? And I would contend it's not. It's not really low cost, because you can't have an incredibly low grade lepidolite, being turned into a value-added chemical with hydrofluoric acid if it was fully costed for the purpose of all the environmental remediation and the low grade of concentrate input for a high strip ratio. All those things do not translate to low cost, despite what you're told. So the effect of that, I'm contending is to really just continue to build out the right-hand side of the cost curve, which ultimately means, in the end, we probably need to book a higher cost for industry in the medium term to underwrite the supply base. It might be that very important projects got starved of capital in this period because risk capital got scared off in Western markets. I don't think we're there yet, but nonetheless, that's possible. And as a result, the net effect is higher pricing in the medium term, probably for longer, to continue to sustain the industry. So the other inescapable truth, I alluded to it earlier, the confluence of serious scale, and by that I, not even just, hundreds of millions of tons in resource, the way it presents in the ground. So big, fat pegmatites that are productive and minimize dilution. That, combined with convenient location and the right mineralogical inputs to increase recovery, that is rare. That is the rare confluence of events that contributes to what you would call, apologies for the generic statement around a world-class project or a tier one project, but the truth is that's what it is. That's what it's defined by. High grade, right mineralogy, scale, not just even in terms of total tons, but the way that pegmatite and the spodumene presents in the ground, that's rare. And that's why certain projects are always going to be a classic moneymaker in almost any part of the cycle. And, again, iron ore analogy, there's not many Yandi mines, there's not many mining area Cs that can deliver for $35 a tonne and still get $100 a tonne in the market today.
And that is no doubt why you have joined Patriot, because you identified and saw that to be a world-class mine in the way that Pilbara, Pilgangoora is. We've talked about the analogy with you and with Dale Henderson of Pilgangoora and Pilbara being like Fortescue, the new force in lithium, the new force in iron ore. But your experience at Atlas Iron, those were not world-class mines, right? That was a collection. We worked for a company that we worked for Ferroz, right? Which Atlas bought. Atlas bought a lot of small developers, but ultimately went bankrupt, right? I'm not actually sure, not to take you down a negative memory lane, but nevertheless, you have had interactions with Chris Ellison, through that. You've had Minres has a contract, I think, with Pilbara. But if I look at Minres's strategy, Chris Ellison's strategy, I think he bought Bald Hill, he's in Essential, Global Lithium, Azure, is he in Wildcat? I can't remember. What was it? I'm missing one. Delta Lithium. Azure, you could argue Liontown, are big mines, but the others are not, right? And he's involved in kind of neutralizing kind of stakes. So I wanted, and then we spoke to Dale Henderson and said, okay, why hasn't Pilbara done anything? And then he reminded me, of course, he didn't really need to remind me that the best deal ever, I think, possibly in lithium was the one you did, with buying Altura essentially for replacement cost at the bottom of the market, $150 million. So how do you assess the strategy, of Chris Ellison and Gina? Yes, Gina's making tons of money in iron ore. Chris Ellison just did a $1 billion bond offering. I think his M&A activity kind of coincided with having completed that bond offering. But there's also an element of, we're calling this video, Western Australian, lithium patriots, right? Like your family, has a long history, I think, in the mining industry. Gina Reinhardt's clearly does. I know Andrew Forrest does. There definitely seems to be an element here between Chris and Gina to thwart, even friendly foreigners like Albemarle or SQM. So if you could speak to that, you're reading the tea leaves of what's happening there. There's also some rumors that both Chris and Gina have stealthily, and maybe even Pilbara, been buying small stakes not yet disclosed in some of the Canadian assets. But let's leave that for a later conversation. What's your assessment of all of this M&A activity by Chris and Gina predominantly, versus, the foreigners? What's going on?
Yeah, no, you've raised a couple of interesting points there, mate. And the before we just discuss their moves in lithium, there's a little bit of case history that's worthwhile reflecting on, because I think as it relates to Atlas Iron, actually, because it helps to underwrite the theme that I was sharing about where long run pricing lands and the relative value in assets over time. Oh, by the way, we managed to keep the doors open at Atlas. We renegotiated with the bondholders, and there was an equity swap for basically to pay back the outstanding bond. So I think the best way to describe it, Howard, is that we managed to save the furniture in late 2014, early 2015. The reason I'm reflecting on that point is that those same assets today are now owned by Hancock Prospecting, of Gina Reinhardt fame, and those same assets in the new price environment are probably at about the 50th percentile of the cost curve and actually make really healthy cash flow. Our problem at Atlas Iron was, in many respects, we were ahead of the curve in collecting those assets. But it is absolutely the case today that those same assets are making really strong cash flow as a function of the new price that's established in iron ore. So I feel like that's worthwhile sharing, because it has the effect of reinforcing the point I'm making about what's really going to happen in lithium material markets over time. There was no analyst globally that would ever have imagined a long-run price in iron ore above $85 a ton. But it hasn't fallen below $85 a ton for the best part of kind of 2 or 3 years now. And it's the seeds of that opportunity for industry were sown, back in the period of time where we were struggling to keep the doors open at Atlas Iron. Yeah, that's worth sharing, just to reinforce the point I'm making about what's happening to the right-hand side of the cost curve in the lithium world. As to
so on that, so do you think Chris Ellison is with plays with some of these smaller mines, playing Hancock, collecting those other mines? Because I don't know where on the cost curve, the Bald Hill, Essential, Delta, et cetera. I don't know that the first quartile. I think they're probably second quartile. Do you think that's a similar strategy, is taking that lesson?
Yeah, no, I think that's probably right, Howard. By historical measures, they may not be low-cost mines, but there's a reasonable chance, as the industry continues to keep expanding to support demand growth, that they become genuinely competitive. And that's a motivating factor, at least in part, I would say, for the acquisition strategy to address. I don't have any particular sort of special insight to the strategy of mineral resources in lithium, other than to say that they've made a very, very successful business of, buying assets at lows in the market and selling high. That's one thing that's worked incredibly well for MinRes over the 18 years of their existence. But he's also done a really good job attaching mining service enterprise to those assets that he's invested in, and he thinks about them, I think, as being an annuity style business where it doesn't really matter what's happening with the underlying commodity, because I'm still making reasonable cash flow from the mining services I provide. So a very different model, nonetheless incredibly successful, and he's looking to deploy that en masse in the lithium world. It seems to me that's a pretty sound kind of model for MinRes to deploy. In the case of Hank, and of course there's also that theme around, Western Australia is his backyard. So it looks to me like, that's going to work for him over time. In the case of Hancock Prospecting, maybe the motivation there is just a little bit different. Again, I'm only providing opinion without having any special insight to the Hancock organisation. Ultimately, the big Roy Hill mine, which is a very strong cash flow asset in today's market, is going to have an end date, in which case, being able to diversify interests while you're making incredible cash flow, to me also looks like a valid strategy. And the assets are not that common, that you're able to actually bid for. So that's what's created a bit of tension and a bit of fear of missing out, and hence the action underway. I think I might have said when we've spoken before, Howard, the way I view it is to say there is a reasonable chance, for all the dynamics that I've described about pricing being stronger for longer through the cycle, there's a reasonable chance you're still getting these assets cheap, and it probably will motivate more M&A, even compared to what we've seen today. To me, that seems highly likely because there are lots of organisations globally that aren't that well set in the new energy world, and if you're one of the big guys with the protesters out the front of your AGM, that's going to become a much bigger part of your world in the coming years. You've really got to be able to demonstrate that you're setting yourself up for the new mining economy, in which case, inevitably, more mature assets are going to get bought. They are. That's what's going to happen. So, yeah, let's watch that unfold.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LARC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com. Consolidation, like any industry, there's a rush of new entrants, and then you advance projects. There will be consolidation. The question is, several questions. Does lithium, spodumene in particular, emerge to have four big players like in iron ore, or does it become more like copper or some other industries where maybe there are many more mines in the industry? And to that point, you have a fair bit of experience. Albemarle came into Patriot. You're the chairman, so you clearly have had dialogue, with Albemarle. It has been my analysis, our analysis, that there has been, and I think still is, what I'm calling a spodumene duopoly, which was Albemarle and Minres shut down Wodgina for an extended period of time, and then Pilbara, kept Altura shut down for a long time. So the price spike that we saw to 80,000 was a combination of a demand shock, recovering from COVID and battery, but very much also supply constraint, right? Because those two mines were mothballed. You now have Pilbara ramping up aggressively. You've had Wodgina, you've had Greenbushes ramping up. So there's been a lot. It's not just lepidolite supply, and African supply, but you're having brownfield expansions. However, Albemarle holds the swing vote on Greenbushes, and Tangshi and IGO, I think, have said that not taking their full entitlement, and it's unclear if that's because Kwinana is so slowly ramping or what's the rationale. Chris Ellison talks a big game about just ramping up Wodgina, but he can't make the decision, to ramp up without Albemarle's approvals. And Albemarle said in their last quarter, they may slow down the mine. So in my view, we may hear from Albemarle maybe a slowing of the growth, at Greenbushes, because they're a disciplined actor. Like, unlike SQM in the past, I've argued that SQM was just pumping. They were growing from 50,000 tons to 150,000 tons at the bottom of the market. I somewhat blame SQM for Altura's bankruptcy because the price was just so low, and and you had spodumene go below, $500, even $400. So do you believe, am I right in assessing, because I think if Albemarle were to make that move, and if Pilbara, as a disciplined actor, in my observation, the company has emerged to be very professional and corporate, and they're behaving like a big company and they can be disciplined. If Albemarle were to take that lead and Pilbara would also maybe just slow down because the prices have gotten so cheap, you would then have a similar situation we had a few years ago where lepidolite can't make money, so they'll have to shut down, and then you may have that price spike again. Am I right to assess that there's still a spodumene duopoly? I don't know that this is going to continue to be the case with Covalent coming on in Nemaska, maybe down the road, like in a few years' time, maybe you'll have more mines to add to the Sigmas and the Cores and the North American Lithiums. But I still think, Albemarle and Pilbara hold cards at least for the next 12 months. Am I right in that analysis?
Yeah, no, I think that's a credible description for the structure of the industry on the supply side. There's very few really big mines, but they're the ones that have the ability to make a difference. So you pretty much hit the nail on the head. It's really just, at least today, it's really just Greenbushes, Wodgina, Pilgangoora that represent by far the lion's share of the production, in which case, if there's a rational response from supply there, then you'd say that's going to help the market. Going back a step, the demand shock that you described absolutely, was actually what happened in that period, latter part of 21, 22, first half of 23. But there was another very important dynamic in play, and that was the concept of, let's call it, it feels like we're overusing the iron ore analogy, but let's call it the value in use of the spodumene, and the spodumene's ability to capture more of the share in the downstream chemical. That's also an important dynamic to consider in that period of time. So what do I mean by that? Basically, think of it this way. Historically, so pre-2009, you might be lucky as a miner to capture 30% of the margin that was being made at a chemical level for the value in use of your spodumene, supporting the chemical conversion industry. That's roughly where we started in our negotiations with the chemical conversion industry in China, and largely underwritten by historical precedent to develop the contracts that we ultimately awarded to the chemical conversion industry for the first rounds of production at Pilgangoora. Once we'd launched a different model for the purpose of discovering price, and of course everyone now references the BMX sales platform and the auctions that occurred, what actually happened was that the spodumene started to capture a significantly larger portion of the chemical margin. And to me, this is a really important dynamic, because what it started to show in certain market conditions was the value in use for the spodumene being supplied to the chemical conversion industry. And I think you can rightly argue that there was periods of time in 2021 and 2022 where the spodumene was capturing virtually 100% of the available margin at a chemical level. Now, that's a big difference in the extremes, between historical precedent, 30% of the available margin at a chemical level reporting to the value in the spodumene, as compared to something approaching 100%. That's a really, really big, broad band to be playing within. So why am I reflecting on that? I think that the entire supply chain, all the way from, raw materials right through to a cell, and arguably even a car, has a lot more maturity to unfold about where margins ultimately settle over time. And I want to place a reasonable bet that actually the raw materials become a beneficiary of that effect in the coming years. And the reason I'm saying that is because for the same reason China overbuilt chemical capacity. So that's typically what they will do is they construct an industry. They overbuilt. That's absolutely what happened in China. They overbuilt chemical conversion capacity, cathode materials, arguably still today. In which case, when the market turned and demand switched on, of course there's going to be competition for the value in the spodumene. If you can't produce a chemical, you can't make any margin. But eventually you're prepared to give some of it away to be able to produce a chemical and make a margin or a nominal margin. I think the same effect is going to happen in the Western world. And the reason it happens is because it's so much easier to build a chemical plant than it is to build a mine. It's so much easier to build chemical conversion capacity, cathode materials capacity, cell making capacity, and arguably even car making capacity than it is to actually get a mine off the ground. That's hard. And that's why you're going to get these horrible disconnects at different points in time in the cycle that attribute a huge amount of value to the miners. And I think there's a lot more of that to come. Now, I say that and appreciate that everyone's frustrated today. And I completely understand, it is frustrating. There's no two ways about it. But actually, if you're prepared to see your way through the cycle, and if you're prepared to support the business so that you've got sufficient cash, you're a rational actor, you're adjusting your supply response as a function of the way the market unfolds, and even better, if you can execute action or tools that improve price discovery, I think there's a reasonable chance as a miner you're going to do well. And there's no reason to complain if you're prepared to see your way through the cycle. So all of those things, in some respects, are either a function of history, what we've learned, or yet to unfold as the market continues to grow. But there is reason to be optimistic. It's not all bad.
I have more questions, and Rodney has a few as well, but I just want to go just back to the point. Do you think Albemarle, Kent Masters said he might have to look at the mine, in his last quarterly call? Do you think Albemarle will slow down, production at Wodgina and Greenbushes, number one? And number two, if you were still the CEO of Pilbara, would you be cutting back production at Pilbara right now?
Yeah, there's tension there. So to reference Albemarle in the first instance, I have the utmost respect for their business. That's why Patriot's been prepared to entertain a really, what we hope is a very healthy discussion about interconnecting mine capacity with chemical capacity. They're a very, very credible organisation. And what they've built now in the lithium world at Kemerton in WA, that's absolutely first class, an amazing facility. I appreciate everyone feels like it's expensive, but geez, it's obvious what they've built. It's high quality and readily expandable. It's a really, really impressive piece of engineering. And then I want to give them credit for the work they've done in China too, because that's no mean feat either. Doing business in China is not easy, but they've been very successful in building a high quality and bigger business over time, supporting not just China domestic production, but sophisticated Western markets with the sales they make in Japan and Korea. So, yeah, full credit to them, and that's why we've been prepared to entertain a really what's a very important discussion for Patriot about future mine capacity at Corvette and how we interconnect that with chemical capacity. Why am I talking about that? Well, just a big picture view would be incredibly credible organisation. Who knows what they do with a mine or supply response? But suffice to say, they're a clever business. I can't imagine that they're going to either misstep or misread the market. Pilgangoora, what would you do there? Well, they've got a really flexible position. They've got a very flexible platform. 2 plants, healthy operating record now with healthy recoveries and a credible cost base. You'd be thinking about the combination of, when and which of the plants you expand. You you would be considering all that for sure. I don't have any particular insight into the way they think about their underlying production, but I have a lot of respect for the capability in the team.
Okay, so they're delaying their, or they're taking a very slow approach to the downstream integration on their 300,000 tons. You negotiated your deal with POSCO at a much more difficult time. When they started these negotiations, the price was much higher and they were in a very good negotiating position, but they're being very slow. There's no rush. Again, I have so many questions. Albemarle came into Pilbara. There was a lot of into Patriot. There was rumors and talks, maybe Pilbara would come into Patriot or Minres would come into Patriot. As the chairman of Patriot, have you seen any change? There's a lot of spodumene developers out there that are looking to bring on projects, in the next couple of years, and they've appointed investment banks like you had appointed at Pilbara, Macquarie, Azure, I think, Global Lithium, Atlantic Lithium, Lithium Latin Resources have all critical elements. They're all saying that the interest from strategics is as strong as ever, for their projects, but we haven't seen any deals announced on those projects just yet. But you, sitting as chairman of Patriot, I'm sure are getting inbound as well because you had Albemarle. But has there been any change in interest, for the future development of Patriot? Like, how would you assess just OEM interest? Because there's an argument that they should be, that Simon Moore, as we had on the program, he's saying now is the time, the auto OEMs, the battery, the price is low. Now is the time to cut deals, get aggressive. What's your sense of those dialogues?
They've got more sophisticated in their approach. So you're much more likely now when you're meeting with an OEM to have, a mining team on the other side of the table, as compared to just a procurement team. So it feels like some valuable lessons have been learned through the cycle about how you engage with the mining industry. So it feels like there has been a step up there. Corporate interest inbound, yes, that's what happens, and especially with a more significant project like the discovery at Corvette. And actually, that at least in part explains crystallising our views around where we take the interconnection of mine capacity at Corvette into chemical capacity. People want to buy into your company. They do. They want to pick up 19.9%. That's a number you see bandied around a fair bit. We're not ready for that because we've got more value to add for our entire shareholder base. But what we're absolutely ready for is that conversation about future mine capacity being interconnected with future chemical capacity that supports North American and European markets. That's a really important distinction that I can't stress enough about where Patriot's at, as compared to, say, West Australian spodumene. They are two distinct markets, and that's because West Australian spodumene has a natural home in many respects in China, because China had already built chemical capacity. So interconnecting your mine to China capacity is the first meal ticket, and it's absolutely, that was Pilbara Minerals' first meal ticket. But it's not the future of global supply, because nobody is going to accept being 90% plus reliant on China. There is going to have to be alternate supply chains developed. And that's where the likes of Patriot comes to the fore. We are a very unique project in respect of scale and location and mineralogy, being the key criteria for future, low cost and large scale production. We are exactly the sort of future mining capacity that's required to underwrite the scale in big chemical facilities. You can't go and spend $1.4 billion developing major chemical facilities on the back of a 10 million, 20 million ton resource. It's just not going to happen. What you need is hundreds of millions of tons. And ultimately, that's what we aspire to, to be at Patriot. And I think all the hallmarks are there, and that was what ultimately got me motivated to get involved in the project. So two different things: West Australian spodumene, shorter duration supply to China, because the chemical capacity is there. In the case of North America and Europe, the development of a supply chain coincident with our mining capacity coming through the system in the latter part of this decade. So as we sit here today, we'd like to think production from 2028, well, if you're going to achieve that, you have no choice but to have those conversations underway with respect to chemical capacity today.
You don't see Western Australian iron ore going to Corpus Christi and Tesla, or even
spodumene.
I'm sorry, did I say iron ore? Spodumene from Western Australia going to Corpus Christi, or going to Albemarle's, South Carolina, megaplex. And it sounds like you're saying, they're viewing their Kings Mountain, plus Patriot, as a potential supplier for that 100,000. I've thought, the distance is, once spodumene gets to China, it has to travel like a week, on truck. Once something's on a boat, it's not that significant. What do you think about? I hear what you're saying. It makes a lot of sense.
While we're on that topic, you can cover the midstream that you looked at.
Yeah,
so that's another possible semi-solution.
Really important point you've made there, Rodney, for sure. Yeah, I think, in with my Pilbara Minerals hat on, historically, we had thought about the potential of spodumene penetrating global markets, so something beyond China and Korea. But our feeling was that there was better solutions, and that's what motivated, looking at the resource base in North America and seeing what was happening with respect to exploration, and ultimately led to the association with Patriot and the Corvette discovery. To answer your question about does spodumene make its way all around the world, well, the answer is maybe. But it doesn't feel like a long-run solution for industry, because you're moving a lot of waste around and handing your customer at the chemical facility a problem, because you've got, the other 95% of the mass that you've shipped them that has to be dealt with as a waste or a byproduct stream. It's not easy to deal with, especially as the scale in the industry grows, which is where the midstream, Rodney's quite rightly pointed out, comes to the fore. My personal view is that industry is going to realign around alternate products, which I think probably includes midstream products. And to me, the logic is compelling, especially once you've fully costed the carbon footprint in the supply chain. It feels like that's going to be a much more natural place for your industry to settle, because it solves the value in use for a miner. Instead of getting X, you're getting 10X for your credit for the resource in the ground. You're leaving the waste at the mine, which is the most natural place for it to be stored. And as long as you've got the right partners downstream, you're still handing them a high value product. It's much easier for them to handle, because the purification is the last percent as compared to purifying the other 95%. So it feels like a very natural place for the industry to land. Probably a few co-commitments around technology and technology around calcination, particularly if it can be electrified. But it's not a must-have. That's like a nice-to-have if you can achieve it. But you could equally use conventional calcination and still successfully achieve a midstream product solution that's probably better than today, shipping spodumene around the world today.
Rodney, do you have a few more questions, or have we addressed all of these?
She's covered a lot of ground, but I guess just one thing I suppose I'm interested in, I'm sure the listeners as well, is the whole Chris Gina thing and the M&A. How do you see that M&A strategy playing out? Ken, are they friend or foe? Are they going to work together in a partnership, or are they going to go it alone and battle it out with each other?
Yeah, really good question. Interests are at least in part aligned about how industry could grow in Western Australia. A little bit of perhaps a little nationalism further around it as well. Who are these overseas upstarts that are looking to secure our lithium assets? Now, where does it end? Some are very complex. The situation at Azure is not easy to unpick now, because it's even more complicated than what's happening at the ASX company level, because at a project level, there's joint venture interests as well. So a lot more work to be done there before that one's going to be solved. I guess shareholders have to be careful what they wish for too. It's one thing to ride the bandwagon when the on-market purchases are happening, but if you ultimately end up with stalemate, that historically that's actually been quite ugly, on the ASX, and can get very messy for shareholders. So it feels like everyone should pay attention to what's happening there. Now, the fact that it's happened feels like an unusual event, but it's symptomatic of an industry that's still maturing, and the interests of all parties are yet to be completely solved, which is one of the reasons why I think there is ultimately going to be a lot more M&A in the sector. There's not that many places you can go to buy projects with a credible either exploration profile, resource in the right location with the right mineralogical characteristics, all those things that I've explained. Honestly, when you really get to the chase, as much as people assume there is lots of lithium around the world, the confluence of those things is actually very rare, which is why people will typically pick at, a project that seems to have some merit.
I want to pick up on that point. I don't know if they're working together or not, but I've been a shareholder of MinRes for a very long time. And I just sleep well at night, aligned with founder, lead shareholder. I don't know. I think he owns 16, 17%. And I don't think he's going to do something stupid, although, he sometimes says he's making it up as he goes along. But my sense is, again, going back to this kind of spodumene duopoly, which I think he was annoyed, or as much as he touts Albemarle, and it's great to hear you say very positive things about Albemarle. There's a lot of people who say negative things about Albemarle and their decision making and their capital allocation over the years, or their slowness. But anyway, I'm a shareholder in Albemarle and have admired them. But I sense there was friction between Albemarle, culturally very different, Chris Ellison and the management of Albemarle, but Chris just didn't. He made smart moves. He partnered with the teams that know how to make chemicals, but he shifted his mentality to, if you own your own rock, you're God, and it doesn't like not to be in control. So he restructured the Marble joint venture, and now kind of like maybe Atlas, or maybe like Fortescue, he's consolidating a lot. He sees the market emerging like iron ore, and he wants to be one of the 3 or 4 major players, and that's behind, but he doesn't have all the capital kind of like take it over. Anyway, that's what I think is happening from his perspective. But you rightly pointed out, no matter what, with the mine services business, he always wins, good, bad markets. So I think with all of those assets, they're going to pick mineral resources, to do the mine service. And so he has that angle. But do you think overall this M&A activity speeds up or slows down the advancement of each of those companies' projects? Because, and if it slows it down, is that part of, creating these iron ore software like margins in the industry? Is that part? Do you think it slows it down or speeds it up, given the last 3 months M&A?
Yeah, they are complicated situations now. So I think that does make life just that little bit tougher in terms of actually progressing the project. So, yeah, a company that has a clean register that's supported by the right characteristics in terms of project inputs resource scale, mineralogy, that type of thing is always going to get funded. But there's no doubt that the corporate action, I think, probably has the effect of slowing those projects down. So that's part one. Part two would be those particular projects at the very least are really for the next cycle. I think that's because they're not short-term prospects as it relates to mine development. As much as everybody is excited about Western Australia, it still took us basically 4.5 years to get a mine up and running at Pilgangoora. I mean, it's easy to forget about that now, but that's actually what it took. An interesting comparison, for what it's worth, is from the submission of documents for the approval of the Pilgangoora mine to the day we received our project approval. That was about 2 years. It was just a fraction under 2 years. By our observation in Quebec, that equivalent timeline, based on mine approvals in Quebec over about the last 5 to 10 years, is actually 2.5 years. So I look at that and think, okay, in many respects, we've got a similar sort of landscape in front of us as it relates to the project development pipeline at Corvette. In which case, I think we're pretty well placed. And by the way, the team's done an amazing job progressing the project as far as they have in a relatively short period of time. It's under 2 years now since the inception of the discovery. And we've done enough work to make the first submission for our mine environmental process, having submitted the project description last week. So full credit to the team for the work they've already done. And I want to give credit to Quebec as a whole for the effort that's now going into the support for the industry in almost every regard, whether it's funding support, attracting the key links in the supply chain, batteries, cathodes, chemical plants, and you'd expect ore mines. So, yeah, all power to them, I think.
Ben, one of the things I wanted to ask is, when you operated in Western Australia, you've got all of this M&A going on and all of these projects from an infrastructure and a labour and what have you. There was something I picked up in the MinRes quarterlies about some kind of issue or congestion or what have you at port. Is the infrastructure ready for a whole deluge of new projects in Oz?
Yeah, no, it's a challenge, Rodney, it is. Another one I would raise is not even about logistics, it's actually about mining itself. There's a huge push now with respect to underground mining and the scale that's emerging for the number of projects, and for that matter, the scale in the mines themselves. That's definitely a complicating factor for mining in Western Australia, because there's just not enough jumbo operators, not enough drillers, not enough truck drivers that are ready to get this projects up and running, which now includes lithium, but also a gold industry that's running pretty successfully and continuing to expand capacity. So all those things definitely make for a tougher environment, arguably a bit of inflationary pressure. So yeah, I think that's going to be an issue, and it might yet be an issue for public access infrastructure in the Pilbara. People are looking to try and unwind some of those bottlenecks now, and hopefully the capacity comes on in time that it's not going to be a constraint, but who knows.
A couple more questions, and then I have to get my son to school. Where do you think lepidolite is on the cost curve? There's some debate there. I forgot, Rodney, what do you think? But there's some discourse we saw at UBS, JP Morgan. Lepidolite seems to be coming off. Some people are saying it's cheaper. Just hard to know. What's your assessment on? Is that the high end of the cost curve? Where's the bottom? Right, in Western Australia, you have core, and you have some others on an all-in sustaining cost basis. Rodney's arguing. I don't. Maybe you could say, Rodney, where you think these companies are not making money.
I think below 1,200, I think is going to be challenging. I think, Ken, when you have a look at all-in sustaining costs plus when you produce versus when you ship, and working capital requirements and corporate overhead and exploration and whatever, I think if spodumene tests 1,200 or less, I think we're going to start to see some negative free cash flow.
Yeah. That's today. I think that goes higher over time. Again, motivated by novel sources of supply, underground mining, sedimentary hosted deposits, even DLE.
But do you think there's any credibility that lepidolite can operate at the equivalent of $800 a ton spodumene? I'm not buying that in scale. At any rate, there might be the odd operation.
Completely agree, Rodney. I think what China says in respect of cost and what the actual cost is are two completely different things. As I alluded to earlier, you might very well be motivated domestically in China to subsidise some of that production if you thought that it was going to help, avoid a $60,000 chemical price and get it into a band where you really, you think it's fair. But as I said earlier, it feels like a mug's game. You'd be better off letting market forces see capital flow to the right projects, with a view to ensuring that the right projects get developed so that you get a reasonable long-run price, as compared to short-termism that I think is probably underway in the market today. To me, this is the critical issue that's being missed by the ANOS community. When they think about lithium, they want to shape lithium as a function of historical precedent and what China tells them. And I don't think either is ever going to be the right answer for the industry going forward. What is actually going to happen is that there will be, there already is, there's a massive build out happening on the right-hand side of the cost curve that's going to force higher pricing for longer in the medium term. We've just got to suffer through this period at the moment where there's a relative disconnect between available supply, demand conditions, and the effect of China complicating the market.
So where do you think the right end of the cost curve is? Like and is lepidolite the high end, or is it the non-integrated spodumene converter?
Yeah, there's probably a few that sit out there on the right-hand side now. Absolutely low-grade lepidolites are a key driver. Pedalite production, which again suffers from similar issues to lepidolites as a function of grade and processing. But I would even throw in direct shipping ores and say some of that's going to be motivating the right-hand side of the cost curve as well. But it's all been part of China's kind of broader supply response to just get those lithium units into the market. But they're all probably, they're definitely the wrong answer for industry, I would argue, in the medium and the long term, because there's going to be upset in Africa as a function of certain countries missing out. Or otherwise being penalised at the ground level. And there's going to be environmental penalties downstream when you think about chemical processing, and who knows how they ultimately get costed. What you really want is you want those very large-scale, low-cost mines in the market, underwriting the industry's core. The problem is those mines are relatively rare in the same way that they're rare in copper and iron ore, and the story goes on. So anyway, the key point is the right-hand side of the cost curve is probably not getting enough attention, real attention, as compared to people listening to what they want to hear.
Do you have a number in mind what you think the medium-term high end of the cost curve is?
Yeah, historical precedents would have had, lithium sort of in the world of, let's say, $10,000 to $15,000 a ton for a battery-grade product. I think that the new normal is probably more like $25,000 to $30,000 a ton, and that's ultimately where industry, on the fulcrum of volatility that exists in the market, that's where the market starts to swing.
When you negotiate, the more sophisticated counterparties on the OEM side and the battery side who now have mining teams Our assessment, looking at, Lithium Americas and GM, looking at Ioneer, and the deals that they cut, I don't think that or Livent, with BMW, our assessment is not that they're getting 25 to 30 on price floors, right? We think it's like closer to 20 or maybe even the high teens.
Yeah.
We don't have definitive information about this, but just like channel checks with various friends and that we're talking to about those negotiations, is that it hasn't set in to the OEM's mind that 25 and 30 is the price that they're comfortable to pay on a floor basis, maybe on the high end. But if they're trying to get debt, if the company's saying we could produce at 7,000 or 8,000, the OEMs are saying, okay, if you're going to produce at that, then 15 or 18,000 should be, sufficient for a floor.
Yeah. So the question to be asked there, is it really $7,000 or $8,000 a ton cost? I guess that's one way to look at it. But then again, if I was an OEM, I'd be saying to them, if I was negotiating with them today, I'd be saying, but hang on, you're paying $35 a kilo in Japan and Korea today. It just so happens that in China, the volatility has motivated a price that's probably today's, so I don't know, 20 odd, or even sub 20. But you're still paying $35 a ton in Japan and Korea. So not all lithium tons are the same, and not all lithium tons by jurisdiction are the same. It's a pretty complex market, and of course, China is incredibly volatile. The interesting thing to me is that equity markets fret about the China price. And I understand, it's a big part of the market, but don't lose sight of the fact that in Japan and Korea, they're still paying $35 a kilo. Now, would anyone have been disappointed with that price, just 2.5 years ago? Well, the answer is no, they wouldn't have been. And if you really want to translate what's the value in the spodumene at $35 a kilo, there's every chance you'd be getting a lot more than say $1,200 or $1,300, $1,400 a ton that you might be getting today when you're selling to the China market. So I don't know. There's a lot to be unpicked, and it's probably a whole other conversation. But the other point I'd make is don't lose sight of the variability in the value that the spodumene can attract in respect of the chemical margin, because that is also a huge variable in the market, and at least in part explains why Pilbara was able to get $8,000 a ton sales away, as a function of the BMX platform, because they were stealing the lion's share of the downstream chemical margin, not just because of the value of the spodumene itself.
So you've said that multiple times, and you're aligned with Chris Ellison, you're aligned with Rodney and me. Keep it simple, stupid. Keep it spodumene stupid. Spodumene software margins. That's where you're sitting. Value in use as continuing to be there relative to the chemical margin. It can't be 100% spodumene and zero on the chemical. There have to be chemical margins over time, but 50, 60, 70% margins that, Rio Tinto and BHP and Fortescue have been enjoying for a long time. That's your bet. That's our bet. Final question, and then a couple more analogies to, the Rolling Stones, is, in September, we were speaking to one of our clients. We hadn't spoken to him for about a month, and he started the conversation. It was just like, it feels like 2018. And other people were like, oh yeah, it feels like 2018. So 2018 followed 2019, and then it was COVID. It wasn't until like Battery Day, September 2020. So if we were in 2018 or are in 2018, do we have, 18, 24 months more here, or has the cycle been compressed where like 2018 in September, we're now in kind of like 2019 in December, like how close to the bot, like, because again, just the Wuxi futures, is every day going limit down. I get the fast markets, the S&P, everything is gloom and doom, to use a Rolling Stones analogy, song analogy. What's your assessment of where we are if you were to compare it to that last cycle?
Yeah, cycle wasn't even just about price. It was sale versus no sale, and that's one of the things about the lithium market that should never be ignored as an industrial mineral, and not being anything like the liquid market that say iron ore is. It's not as though under certain circumstances there is a clearing price for every ton. We got to the point where we couldn't sell tons and literally ran the mine on a campaign basis, and we'd celebrate and ring the bell once we made a sale, and we could restart the mine. So conditions then were I feel actually quite different to market conditions that exist today. I'm not aware of any one customer saying, do not deliver that vessel. But I can assure you that was what was happening in 2019 and 2020. Very, very difficult conditions, not even just about price, because there was a time when you just couldn't sell a ton. Didn't matter what the price was, they didn't want it. So we're not there. And I honestly, I wouldn't really expect that to be the case in the current market, because the market's grown. It's probably even in that period of time, it's probably gone close to 2 or 3 times growth already, with another sort of 2 or 3 times to go before the end of the decade. So it feels like that circumstance would be unusual, and therefore we can be reasonably optimistic. As to the cycle itself, well, I look at the demand conditions and actually still have some reason to be optimistic. China's still printing record sales in EVs. They are very, very strong now in export capacity. I don't know how close you guys have been watching that data, but they've tripled exports in EVs over about the last 3 years.
Yeah, it was one of my questions, but you covered it with the legacy OEMs, because I think they're losing out in the rest of the world hand over fist.
Yeah. No, that's exactly right. It's not as though that in Europe they don't want to buy EVs, they just don't want to buy expensive.
They want BYD.
Yeah, exactly. Yeah, they've hit the right price point. And interestingly, the fact that lithium prices have come off, well, that's a key contributor to lowering the cost of the EV. So you grow the market. I don't know. To me, Western OEMs are on a hiding to nothing, and they're going to have to change the game. All governments are going to have to change the game to support the industry, which are huge industries in the US and Europe. So I feel like that's yet to come. Some signs are there, with probably more action yet. So in light of those demand conditions, I actually I thought, reasonably expected some stability in the market already. It hasn't worked out that way, but I still remain optimistic that we don't need to hit the panic button. You would like to think that the cycle is going to be relatively short. I look at that short interest in Pilbara minerals and think, gee, that's a pretty dangerous bet to me. The minute the market turns, that's going to be a bloodbath, you would think. And it's not
what minute? What month is that minute?
Yeah, exactly. Well, that's the $1 million question. It's a big short interest, and there's $2 billion worth of stock that's got to be bought back. So, yeah, it's for a stock that admittedly is liquid, but $100 million a day, you're not going to buy back your $2 billion worth of stock in a hurry. So it's going to be a problem once that day comes. Short cycles. The growth in the market, I think, has the effect of creating short cycles because demand conditions are really strong. You mentioned ESS earlier. China's a big player there. They've got the right engineering solution around LFP batteries. They're starting to penetrate global markets more fully than they did historically, so we should watch that one, in addition to the EVs that they're shipping abroad. So, yeah, I still remain optimistic about this industry and the money to be made through the cycle.
Okay, Ken, thank you very much. I got to get to my kids to school, but we almost called Canada Rocks last year Hot Rocks, which was the first ever greatest hits album from the Rolling Stones, but I switched, I think, to Lithium Rush because Rush was a Canadian band. But you can't always get what you want. You can't I Can't Get No Satisfaction are songs that we have used. I remember interviewing in Santiago fast markets, which was a big down market. Rolling Stones seem to have more negative songs than positive songs, as I've tried to create narratives about them. But time is on my side, or time is on all our sides. And going back to their latest new album, Hackney Diamonds, I've referenced this, but there's a great song. If you haven't listened to this album yet, Ken, I encourage you to go on Spotify and download. Not only the Angry Lithium Angry is a good song. I called this Angry Lithium in a recent Lithium Bowl, but the song with Lady Gaga, Sweet Sounds of Heaven, is my favorite song. So Sweet Sounds of Heaven, Lithium, Nirvana. I feel like Almost Famous, Lithium 3.0, I used as an analogy, to Almost Famous 2.0 in the last cycle. We're frustrated. We didn't call this. There's a lot of reasons, for it, but you think the cycle, it just is a matter of, we were very bullish in March, right? And it's now 9 months later. Hopefully we'll interview again sometime in the spring or summer of next year, and Pilbara and Patriot stock will be higher. If you're a betting person, would you think it's like flat, higher, or lower by 6 months time from now?
Yeah, higher. Yeah. I think that's not unreasonable. Yeah.
Okay.
I'm a Foo Fighters fan, mate. I was at their concert here in Perth last week, and China is the monkey wrench. That's one of my analogies I'd share with you, mate. They're a complicating factor in the market, and I don't think their demand is going away. So eventually you see stability emerge, and I do feel like there does need to be a higher price. Otherwise, you're not going to attract the capital to the market. So that's ultimately where we land.
Thank you for that. I have Keith Coughlin of European Metals Holdings sent me a video from that Foo Fighters concert. I don't know if you saw him there, but I think we have the song we're going to use for the teaser for this interview, the Foo Fighters Monkey Wrench. Thank you very much, Ken Brinsden. Again, this was long. I don't know if we'll break this into a two-parter or just one long interview, but I think our listeners are going to very much appreciate the very in-depth. We covered a lot of ground here, and thank you for all this time.
Pleasure to be with you guys. Thanks for your time.
Okay. Take care, Ken.
All the best.
Thanks, Ken.
Bye-bye.